Welcome to Nasdaq Trade Talk. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Alex Coffey, trading and derivative strategist at Charles Schwab, as well as Max Cabasso, managing director on Nasdaq's Market Intelligence Desk. We're here to discuss the performance between the Magnificent Seven stocks as well as equal weight S&P 500, just to see if the divergence of the market is finally broadening out. It is great to see that both of you, as always. Welcome back to Trade Talks. Alex, it's been a minute here since we've had the opportunity to catch up. We're past the election. There's a lot of hopium as it relates to anticipated Trump policies going in. Still have the AI and tech theme dominating the markets. What's your sense overview of what investors at Charles Schwab are focusing on right now?
Yeah, Happy New Year. Good to be here, Jill. And when you look at it, I think you're highlighting, I think, the same themes that really dominated not just 2024, but large parts of 2023 seem to be kind of where the early excitement is once again. You throw in there digital assets as well. That's certainly been a conversation in recent months. And I think that also probably tied to the incoming, now current administration's kind of feelings about that particular space versus the prior one. But it's also these ancillary plays within this AI trade as it's broadened out. It's not just the semiconductors anymore, but now it's actually the companies that are, putting this stuff to work. I think Palantir had a huge year last year. That's still one of the most commonly traded names that we see, but also some of these nuclear power companies, the Vistras of the world. You even see it in GE Vernova as well, getting some excitement. So a lot of these names that are seen to have been kind of that next order of magnitude as part of this AI build out are still getting love and attention.
Yeah, and Max, that's a consistent theme that we've been discussing on the desk. In fact, when Market Site yesterday had a relatively same conversation when it comes to the obvious names that are associated with AI within the tech sector. And now that story is really about, okay, what's the ROI on this, the 2-year hype cycle we need to start showing, what this means for the business and the strategy. And now it's time for these derivative plays to stay out. And we saw that a bit last year within the energy and utility sectors. What other areas are you seeing where the AI theme is really becoming ingrained in the longer term strategy and how companies are deploying assets for investment?
Yeah, like we talked about yesterday, healthcare is another one that's going to get a lot of attention. We'll see how that comes in. Also, just it feeds into infotech, but not directly to the chips like we've seen. So, to start, obviously last year with the NVIDIAs of the world, but data security, data privacy, internet security. So we're seeing a lot more attention there. Some of those names had really lagged. Some that were in the N100 had kind of lagged last year. Starting to see a bit more of a pickup in the software space. Expectations for a pickup. We'll see. Obviously, earnings are yet to hit. It's for fourth quarter, but we're seeing a lot more reports of expectations of software spend kind of picking back up, and again, kind of refreshing the firewalls and internet security. Obviously, we've talked about quantum, a few weeks prior. We'll see if that actually gets, if that comes to fruition. But again, that introduces a whole new aspect to data privacy and security, not just for companies, but Bitcoin. Everything kind of feeds into that. So if these activities actually start to come to pass and we start to see additional information, and quantum really start to hit, we're seeing a lot more investment into the internet security, again, protecting. We saw a bit of a change a few years ago when we had a lot more working from home, kind of different endpoint protection. Now they're starting to bring people back. So we'll see if that makes any changes to kind of where the internet, security spend is, but it's starting to see a lot more activity in that space as well.
Yeah, I think we're only continue to see more spend within the cyberspace because of how quickly these technologies are advancing, and more data begets more data, and those vulnerabilities certainly open up as well. Let's pull up your first chart here, Alex. I want to take a look at the 3-month performance of the Mag 7 versus equally S&P so that we can get a more technical look in terms of the broadening out of the market.
Yeah, one of the things that I think was, and this is important to note too, I would have probably had this same conversation at the beginning of 2024 as well, is that we do have this very concentrated, top-heavy market. And of course, it's become to be known, this Magnificent Seven trade of some of those big mega cap tech firms. Of course, they're really outsized in the Nasdaq 100 as well. But these names, when they're doing well, are driving the activity. This chart shows the teal line is their performance just over the last 3 months. So this is going to capture the election timeframe where we did see, sort of broadening out briefly, but it still shows massive outperformance there. And then those other two lines, the pinkish, violet colored one is just the cap weighted S&P 500, its performance over the same time frame. And then lagging below in yellow is that equal weight S&P 500. Now, the importance of this is, of course, we know the benchmark index is cap weighted, and these big companies that make up the Mag 7 that are outsized pieces of the S&P 500 drive those gains. What you really see is the equal weight has kind of gone sideways, and it continues to be an underperformer. Now, today, that's not the case. Today, you have about 62% of the components in the S&P 500 higher, and you look at Mag 7, NVIDIA, Microsoft, Alphabet, Apple, all dragging, and that's the recipe, of course, for these days that are kind of sluggish, but it'll show bright green when you look at just the components of those indexes. Nasdaq 100, of course, lagging today because of its outsized exposure, but it just goes to show the risks of the concentration. You might think that you're benchmarked to the S&P or the N100 and that you are diversified, but because of how much these companies have swelled, it's really becoming more and more exposed if there is drawdowns in them. Now, they've done well because they are in the right places. They're the ones investing in AI. They're the ones that have these build-outs going. Oh, and by the way, they sit on huge cash piles, which doesn't hurt when interest rates have gone up as much as they have. So they've done well for good reason, but that doesn't mean that concentration risk doesn't exist.
Right. Those are great points that Alex makes, Max. And it makes you wonder, without that narrative of AI being introduced so quickly into the market in November 2022, it makes you think what this conversation would look like, not only in terms of performance, but where the chasing would be in the market, and what would be next in terms of how we're thinking about advances in technology and corporate strategy overall. It really is. I mean, the past 2 years could have been shaped very differently.
Yeah, for sure. I feel like we've hit on it a bunch recently, but the fact of the headline numbers, the S&P, we've had these back-to-back years. We talked about it yesterday, actually. These back-to-back years of outperformance, 23, 24, 20+%. But when you kind of go under the hood, it's really a few of those stocks. We're waiting for that catch-up trade. We've seen Russell has really underperformed for the past few years. Even again, starting off again this year, again, it's been weaker. The impact of rates on the broader market, that's one of the other things we keep talking about is, hey, the market keeps chugging along despite rates being where they are, despite the 10-year, backing up even after the Fed cut. We're starting to see, market's holding up. Who would have thought the market would hold up so well, going from 6 cuts down to 2, and it's really been carried by those Mag 7 names, and the broader market is really not performing well. So it would definitely be a lot bigger of an issue, I think more of a headline, if we didn't have this new AI trade that's been really carrying us the last 2 years. That under the hood performance has been a lot weaker than the top line numbers have shown. Now it feels like we're kind of getting off of the Fed super cycle, I would almost call it, where everybody's waiting in bated breath for what is the Fed going to do? What's the Fed going to do? Feels like we're able to kind of digest that a bit more. We're seeing a bit less volatility there in terms of bond moves. So maybe the small caps will start to catch up this year. But again, it's been a bit uglier for those names versus the Mag 7, which has really been holding up and kind of pushing through this rate cycle.
Yeah, Alex, which is interesting because going to 2024, the market expected 6 to 7 rate cuts. We certainly didn't get that. The Nasdaq 100 up 36.6% versus 21.7% over 5 years and 19.8% over 10 years. And it certainly feels as if the focus hasn't necessarily been so much on the Fed as now we're thinking, okay, corporates need to show ROI. We have a new administration coming in with some very bold policy goals. So let's pull up a chart here when we look at the 10-year versus the S&P, because it hasn't necessarily played out perhaps as the market had expected by not getting the rate cuts that were anticipated.
Yeah, this is interesting. So this goes back to the Fed meeting in the middle of December, basically the day before, and then it also comes through present day. The blue line is S&P 500 futures. The white line is 10-year Treasury note futures. So this is actually bonds in price or notes in price, not in yield. And what we've really seen is the correlation between those two products, which is historically seen as kind of a relatively inverse correlation. We typically associate bonds going down with risk on, as long as it's not a major shock like we saw in 2022, and that's sort of the idea behind the 60-40 portfolio. Bond spikes is sort of that risk off sentiment. But what you've seen is basically since the Fed meeting until the inauguration day, these two were basically in lockstep, which basically said, hey, on days where yields were spiking, that's when pressure was put on broader risk assets as represented by the S&P 500. Now, one would argue that those kind of periods of time where strong correlation between these are, simply just periods in time. This isn't the historical relationship when you go over the long run. However, on Inauguration Day, it could be a short-term blip as well. We've seen the more historical inverse correlation return. Now, this to me comes down to, why are these products moving? Post the Fed, it was a repricing of expectations of Fed policy, taking cuts out. And I made I've made the point several times over the last few weeks for those who have seen me or heard my commentary, where the easy part of that is over. Now you're basically asking the Fed to start the market to start pricing in Fed hikes. And that's a much different conversation. So we're at a point now where yields seem relatively anchored without an absence of major surprise. And on days where yields are moving higher or bond prices lower, it's probably a reflection of confidence, not necessarily fears, the same way that it maybe had been just a month ago.
Yeah, and that's a great point that you make the distinction between confidence and fears, because it kind of mean the same thing, but two different sides of the coin. To wrap up here, Max, when you think about going forward in the near term, earnings are really going to kick in, and we're going to hear how companies are thinking of that ROI and their AI strategy, as it's certainly ingrained everywhere. And then first quarter guidance tends to be, it's a little bit harder to predict versus third quarter because you have a little bit more insight what the year's going to look like going into the fourth quarter. So it's going to be, I'm curious to hear what management has to say about what taxes, what tariffs, what that roadmap might look like, prior to kind of getting the insight and the clarity that they need.
Yeah, absolutely. I've actually seen a few. I had two last night pre-announced, which is usually never a good thing. So it's been a bit of a struggle in two different spaces. I'm very interested to hear not so much the numbers they're guiding, but the words they're using and how they're answering questions on their calls. Like you said, first quarter guidance for the full year. If you're guiding for 2025, it's a bit of a crapshoot. It's a lot of time left. But to hear, is there confidence in there, or is there a bit more of that quietish? Yeah, we're confident, but there's some potential headwinds we're looking at, or is it full bore? Again, they might, I don't want to say sandbag the numbers, but keep it a little more conservative. But listen to the tone of the call. You can usually get a sense of kind of what everybody's saying. Is it, again, going to be another focus on, especially in the AI space, CapEx, or does the shift to, yeah, we're actually going to start seeing some returns. We're starting to see new products get delivered. We're starting to see new apps get delivered. We think that there's actually a runway here where we start, kind of actually taking in some capital now versus just spending. It was kind of that focus from a few years ago where rates were almost zero, and it was the growth. And then drop of a hat, it switched to, okay, we're done with the growth story. Now you got to make money. You got to show us profits. We don't care if you're growing anymore. It's not growth at any cost, any price. Show us profits. And I'm interested to see if that starts to change, if the tone changes this quarter, or even in the next few quarters of, okay, now it's time to deliver. It's not just spending and building out. You're going to get obviously a lot more of the spending with the mega cap, the Nvidias, the Microsoft. They just talked about it with Project Stargate the other day. They're going to be spending more, but at what point do the rest of the companies that don't have those unbelievable balance sheets get to say, okay, we can keep spending. It's okay. When is this going to start showing something? And that's kind of what I'm looking for now is 2025 going to be the year of that we're actually going to make money off of this, or at least show some real revenue here. And it's not just a hype story anymore. It's actual products.
Yeah, which is interesting. Is you can glean a lot of that when you see common words within the transcripts after. So one year, it's pandemic, right? 2020, 2021. Then ESG was, a hot word. But I feel like this year, okay, AI, taxes, tariffs. There could be a lot that comes up. So I'm curious to see how many hot words we see and what they're reflective of. So I think that's going to be one of the more interesting parts of earnings season. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.